Moving back to Nigeria, like I mentioned, it's been a mixed picture. Nigeria was also down on Friday, down about 0.75%. The NSE index closed at 32,950 points. The Naira, we've spoken about the recent weakness there, and we'll be getting to that hopefully at some point during the course of the week and see how the MPC decision impacts that. But for on Friday, coming back to the equity market, the pressure was really from the banking stocks. We're expecting banking results as early as this week. Full year 2012 numbers should be out this week, and so it'll be interesting to see how the market reacts to those numbers. But on Friday, we did see some fatigue with the Ghana stocks down just about 1.5%. Joining me in the studio to break down the market and, of course, the inflation numbers that were also out over the weekend. February inflation up to 9.5%. Joining me in the studio to give us his thoughts is Ayodele Akinwunmi, Head of Research at FSDH Merchant Bank. Ayo, it's always great to have you in the studio.
Thank you.
We'll get to the inflation numbers in a little bit, but let me bring it back to the markets. Like I mentioned, in Nigeria, we did see it come down about 0.75%. We're seeing some fatigue in the banking sector. That was down about 1.5%. Do you think that fatigue is justified at this stage? Some people say that some of those results are already priced in. Are you expecting a rally when we see results?
Thank you very much, Wole, for having me this morning. We don't expect much rally when these results are eventually released to the market. We think that the expectations of these results, most of them have been priced in. However, there have been some level of profit takings, especially from the mid-cap banks like Sky Bank, like Diamond Bank, also Access Bank. For instance, for First Bank at 2021, I think it's fairly priced. We think it may have be able to achieve about 23 when the results are eventually released. Zenith Bank, I think it's fairly priced. UBA, I think, is fairly priced also.
What about some of the top tier 2 names? Some people say Diamond, there's still value there. Fidelity Bank, do you agree?
I agree there are still some values in Diamond Bank. We have values in Sterling Bank. We have values in Sky Bank, as I mentioned earlier.
All right, so we'll see how the market reacts to the numbers, and most likely we'll probably see the likes of Zenith and GT Bank kick things off. But let's move back to the inflation numbers. Like I did mention earlier, 9.5% in February. Broadly in line with, I think, the market's expectation, broadly in line with your expectations. I imagine your thoughts about the key takeaways from the numbers that were released over the weekend.
Okay, I think we released an inflation forecast of 9.3, so I mean it's in line with our forecast, an increase from 9% in January. This year we think single-digit inflation numbers have come to stay. In March, we think it's going to go down a little bit lower. But then in terms of how market will react to it, we may likely see little reactions from yield, especially in the short-term end of the Treasury bill. We don't expect much reactions from government bonds, federal government bonds, and other corporate bonds in the market, but the Treasury bill market may likely react to that.
What about the equity market? Do we see any reaction really when we see this month-on-month or monthly inflation numbers?
Not really directly, but what we see actually is that as the fixed income market reacts in terms of whether the yield goes up or comes down. If the yield comes down,
that has a bearing on
then
equities.
That will have relationship to the equities market. There's likely to be a kind of a portfolio shift to equities market. If yields goes up, they may likely have a portfolio shift against the equities market, as well as investors begin to take position in the fixed income market. But this number, pretty well, we don't expect so much reactions in the equities market on account of that.
Of course, one thing that will definitely impact the fixed income market and perhaps even the equity market is the MPC decision tomorrow. And I want to get your thoughts on what you're expecting out of that. I think, like I mentioned in the interview I just had with Kubi, that I think before last week there was a sense that yes, maybe there's room for some weakening of monetary policy, but given the volatility we've seen in the Naira, I think a lot of people may begin to think twice around that. But what are your thoughts? Where do you see them changing things, if at all, tomorrow?
Okay, we released our expectation and policy options last week on the MPC that will start today and end tomorrow. We think that policy easiness, particularly in terms of cutting rate, is no. We think that hold is most likely. We think an increase is not good. Now, there are justifications. There are no justification for a reduction now. Yes, we have single-digit inflation number, but then the focus of the federal government, the MPC, now would then be on stability in foreign exchange. market and exchange rate.
So you think the focus is shifting to that now, given what we've seen recently?
People have said there is a need for them to ease policy to boost growth. 6%, 6.5% growth rate in the Nigerian market, I think it's something good. And the central bank is comfortable with that. So there is no incentive for them to lower policy rate to boost growth. The growth for them is good enough. Now, when you look at the antecedents, and particularly the way the central bank react and the MPC in particular react to federal government spending and fiscal stance, in 2011, the NPC increased rate in March by about, I think, 50 basis points on account of expansion in fiscal and budget. Now, in between September and October, they increased rate by over 325 basis points on account of the same factor. Now, looking at the budget and assumptions they give this year, the oil benchmark they have there is about 2.53 million barrels per day. The latest number we have from the National Bureau of Statistics is about 2.1. There is a gap.
Actually lower than that.
Yeah. Now, exchange rate 160. Current exchange rate now is not in that line. Now, yes, that's up to the upper limit of what the central bank is saying in terms of 150 plus and minus, 3%. Now, if you are able to exchange the income from oil at 160, market may gradually move to that level, and which may actually spur central bank reacting in terms of raising rates. But we think raising rate now is not good. Now, in terms of the focus of the central bank now will then be how do we continue to encourage foreign investors. Last year, around between June and July, there was a lot of pressure at the foreign exchange market that led to a decline in foreign reserves. Currently, very comfortable level now, but then our forecast is $51 billion this year. We have not got to that threshold. But so the central bank would not want to, it's by foreign investors to begin to go back, or there will be a capital flight that will affect the foreign reserve and the foreign exchange rate. So lowering rate at this meeting to boost growth that is very robust as we speak, will affect foreign inflows, which has aided the foreign reserve thus far. Now, it may equally discourage foreign investors. It may also lead to a capital flight in the market, a runoff, which the central bank cannot cope with at this particular time. You remember that at the end of this month, Barclays Bank will include federal government bond in the emerging market bonds. Now, central bank will be careful on the reaction from the foreign investors as to that. Yes, you may think, say, okay, the rates, the dollar-denominated rates over abroad is still is low at the moment, but then by the time you look at the risk element in Nigeria, the margin is small. So I don't see them reducing rates. The highest they will do is just to maintain rates.